This morning on BRN, where do core bond and core bond plus funds fit into a portfolio? And joining me now to discuss this and a lot more, Matt Brill is the head of U.S. grade investment credit with Invesco. Matt, so great to see you. Thanks for joining us this morning.
Thanks for having me.
Let's start with some basics and just for my edification, what makes up a core bond portfolio?
So core bond portfolio is basically what you think about with overall fixed income for the market. So it's primarily treasuries, agency mortgages, as well as high quality corporate credit, investment grade rated corporate credit, with a little bit of other sprinkling things, but that's your core portion. That's basically 90% plus of the overall bond market.
And what to that end, what is core bond plus? So adding the plus, what does that mean to the portfolio construction?
Yeah, so the plus is a little bit of the spice that gets to go on top of the main meal. So that can include high yield, emerging markets. It can also include certain portions of the structured credit market. So basically, it's just a little bit extra area to get additional yield. It does typically come with a little bit additional risk. But we think if done properly, you can actually mix some of this additional risk in, get a more diversified portfolio, and still get a lot more yield in the process. So the plus adds just a little bit more excitement to the portfolio, which some people want in bonds and some people don't.
Yeah, I like how you describe that, the seasoning. I'm going to think of, being from Maryland, I'm going to think of it as Old Bay. Let's talk about today's market, and we're going to talk about the Fed in a few minutes, but let's talk about today's market and economic environment. How has that and how does that impact fixed income and bond investing today?
Yeah, so there's really two main parts to fixed income investing. One is just growth and the credit quality of the countries and companies that we're investing in. And then the second part is inflation. And inflation is just how fast are prices going? And that's generally bad for fixed income. So you want good quality with low inflation, which is generally where we are right now. We went from an overheated economy with too much inflation, and everybody was worried that the Federal Reserve was going to have to slam on the brakes so much that it was going to stop the economy and send us into recession. So it looks like we're going to get the best of both worlds, which means a slowing inflationary environment, a deflationary environment, while at the same time, you're still getting positive growth. It may be trend growth and it's no longer above trend growth. So put all this together, I think it actually is a pretty good backdrop for overall fixed income.
And that interest rate decision that's coming up by the Fed, does it change the approach to managing fixed income and selecting bonds? You alluded a little bit to it, but how does it kind of factor into the decision-making process?
Yeah, so when people think about bonds, the main thing they think about is the Federal Reserve, overnight interest rates. Some people think about 10-year treasuries as well. They're all intertwined, but at the end of the day, right now, you're in an environment where the Federal Reserve is going to cut because they can, not because they have to. And what I mean by that is they have high interest rates. They put them high in order to slow the economy. The economy is slowing, but the economy is not so bad that they have to cut immediately. It's just them saying, hey, look, we are being restrictive. We need to eventually be less restrictive and actually get to our neutral rate in order for the economy to not get into a bad spot. But we haven't held on for too long that we're behind the curve. And if the Federal Reserve gets behind the curve and is too late to cut interest rates, you're going to see employment really start to have issues, a higher unemployment rate, more people seeking jobs, and you're at the same time going to see companies default. So that's really bad. We don't want that. We want the environment that we think we're in, which is the Fed is cutting because they can, and they know that they should, but they're doing it ahead of time rather than after the fact when things have already gotten bad.
Yeah, proactively versus reactively. Are there certain, with that in mind and with a rate cut in mind, are there certain sectors of the bond market that are more attractive potentially than others when it comes to constructing the portfolio?
Yeah, so as fixed income investors, we're always thinking about the worst case scenarios and the pain points, if you will, things that are troublesome out there. And the one area that certainly is on everybody's minds and on our minds is the lower end consumer, the subprime consumer. Essentially, retail is concerning. We're seeing some spots there where we're calling it the inflation hangover, which basically means that prices went up a lot. And now they're not going up a lot anymore, but they went up so much in such a short period of time that wages haven't caught up. So the lower end of the consumer is certainly struggling to adapt to this. we're positioning the portfolio to avoid a lot of that. However, the higher quality, the bigger, large corporations are still in really good shape. The investment grade rated banks, the investment grade rated consumer non-cyclicals, we think are in really good shape here to kind of weather any storm that could come, which again, we're expecting a slowdown, but not a recession. So overall, we think investment grade credit is a nice place to be. They're getting additional yield versus treasuries into a slowing but not bad economy. And then we're also using high quality, high yield or higher rated high yield. It's almost like an oxymoron, but it's the higher quality portion of the high yield market where we think there will be upgrades out of high yield and into investment grade. So as the economy continues to kind of plug along and be extremely resilient, you can buy bonds that are rated high yield now that we think will be rated high yield in the future. And so we're trying to look for those types of corporations that will benefit from the economy still continuing to be decent enough going forward.
Yeah, well said. Matt, we're going to have to leave it there. So great to see you. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Yeah, thanks, Jeff.
And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place. Details at our website. Until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.